For me personally, when I look out 5 years and I see the inevitability, in my view, of shortages in the copper business, the fact that the copper equities aren't responding, I personally see as an unalloyed good. I also see the wind in the sails of precious metals, and the fact that we've had softer precious metals, and in particular softer precious metals equities prices for 12 to 15 months. It's odd that that causes distress for people who profess to be fond of the sector. For me personally, this is the best of all circumstances.
Today's guest is a supporting sponsor of Liberty in Finance. Welcome back to Liberty in Finance. We have two returning guests, Rick Rule, the CEO of Rule Investment Media, formerly of Sprout Asset Management, and also Tony Giardini, the President and CEO of Trilogy Metals. Gentlemen, thank you for coming back on Liberty in Finance.
Pleasure.
Yeah, nice to be here.
We wanted to talk with you and get an update from your progress in this exploration season, Tony, for our viewers, and we want to dig in and ask some of the tough questions so that we can really get a better understanding about Trilogy Metals and the sort of the promises and the challenges that are being faced, and how you're overcoming those and where you stand relative to the competition. Our viewers are keenly interested in knowing when and where they should consider investing in the natural resources space to take good care of their family's business going forward. So one of the things, this is, we're just wrapping up the summer in the Northern Hemisphere there, and there's been a lot of activity by a lot of exploration and mining companies, and we'd like to get an update from you specifically about the exploration stage season that you've been going through, and any high points you can share with us about that.
Yes, Donegan, thanks again for having Rick and I back. And Rick and I were just talking about being here in Vancouver, but doing this all virtually, which is par for the course these days. The field season has gone well in some respects, but we've run into some challenges in others. In terms of what's gone well is that we had done a fair bit of metallurgical work and geotechnical work that we wanted to get samples so that we could look at the development of Arctic and have that information available to us. So that drilling has been done and completed, and it's being sent to the labs for processing. I'll talk a little bit about what that means as far as timing, but we're very happy in terms of the sample size that we've been able to get. The plan had been to do significant exploration drilling in and around the district as a whole, but unfortunately, weather didn't cooperate. As your listeners may be aware, we're a helicopter-supported drill season, and it runs typically from June to September. And this year, a couple of things impacted us. One was the weather was probably the wettest summer on record in Alaska, and it hasn't just impacted us, but our neighbors to the north. Red Dog had to deal with water treatment as a result of excessive rains, and had a big impact on their operation as well as their own drilling. So that was one thing that happened. And then the second thing was the dearth of skilled individuals and equipment to get the drilling done. And one of the themes that we're seeing in Alaska is that there's really a challenge as far as people go in having skilled people there. So it impacted the amount of drilling that we were able to get done this year, and we'll hopefully make that up in the near term. But the important thing to stress is that in terms of our timeline for development of Arctic, nothing has changed. We got the work done that we needed to get from a technical perspective. And we supplemented that with a fair bit of mapping and soil sample work, which will give us a better indication of the areas that we should be looking at from a targeting perspective.
Rick, I wanted to ask you how general you've seen these kinds of challenges among many companies that you follow, because when you were on talking with us, with I think it was Keith Neumeyer, you guys were both talking about a real impending metals shortage, and that it takes more time than people may realize to actually move things from exploration to development to production, and that the I guess the powers that be in Washington can pass their $3.5 trillion bill saying, okay, tomorrow we're going to have green energy or something like that, but that people don't always realize the boots on the ground realities. So could you maybe generalize for us based on some of the specifics that Tony just mentioned about the challenges they're facing this exploration season?
Well, certainly the first challenge, I think Tony described well, which is a human challenge. The last time there was a boom in resources, I was a young man, and that was a long time ago, which means that a lot of the human resources that are in place are my vintage, or if they're a little younger, Tony's vintage, which means that there's a whole skill set between the people who graduated when we graduated and came into the business and now. And that skill set is short all the way from the CEO level all the way through the deckhand level on drill rigs. And that's something that the industry has to address. Not just our industry, by the way. When the big thinkers in Washington think about inflation being transitory, they should take into account that the starting wage at the Safeway that I shop at in Anacortes, Washington, is $20 an hour. Wages are sticky, and there is a shortage of qualified labor all the way through the value chain in mining and many other industries that has to be addressed. The second thing that you bring up is very true. What one person might regard as a necessary safeguard, somebody else regards as an unnecessary regulation or restriction. And the challenge involved in obtaining the myriad of permits that's required to put a project into production is an enormous constraint when we look at the availability of minerals. When we look at the availability of all commodities, the stuff of mankind, over the next 20 or 30 years. A third challenge, and one where Tony's company really stands out, is the fact that there's been a historic dearth of real exploration, real investment in exploration for copper, for energy, for all variety of things for 3 decades. I would argue that even some of the large exploration expenditures we saw in Canada were more involved in taking a 25-cent stock to 55 cents, which is to say taking a project that had failed in 4 previous bull markets, twinning the one good hole in hopes of jitneying a stock rather than making a discovery. And I think that we're seeing, particularly in the copper business, a really scary dearth of high quality projects that can be brought into production that address what I believe is an absolutely inevitable shortage of copper. That isn't something that's going to face Tony, because his discoveries, while they haven't been drilled off to complete maturity, have been made. But I think those 3 factors, and in fact, the general inflationary pressure that everybody's facing. Drilling campaigns are going to cost more. Construction is going to cost more. Operation is going to cost more. Look, as an example, at energy prices. We were talking 2 years ago about $20 oil. Now we're talking about $80 oil. In energy-intensive businesses, the inputs are going crazy.
That's there's many aspects of what you just described. We've certainly seen the short-sightedness of basically moving all of a country's industrial base and everything off to lower cost jurisdictions, and then you end up with not having the training domestically, that sort of thing. So when you then need to get on to being productive again in an environment where you need it to happen, that doesn't automatically mean that all of those skill sets are suddenly going to materialize there where you need them. What about the next steps, Tony? Beyond exploration, as Rick mentioned, you've already got some discoveries that are underfoot. So what are the next steps in permitting so you can actually move forward on these?
Yeah, no, that's exactly where we're at. We've got a great resource at Arctic, 43.4 million tons, 4.2% copper equivalent. And what we're going to be doing is, doing that metallurgical and geotechnical work on the samples that we've been able to get this year to think about what happens from the development phase. So we're updating the Trilogy feasibility study that we released last year. And we're doing some additional work in terms of looking at the pit slopes and dilution that we used in that study, looking at capital and the timing of capital. And I think, as Rick pointed out, there likely will be some cost creep because that's just what's happening in the industry as a whole. So we'll be updating those numbers at the Ambler Metals level for sure. But the other key development for us is really the permitting process. So we had hoped to kickstart the permitting process in August, but we made the decision. We got all the documentation ready. There's one significant federal permit required. It's a 404 wetlands permit. The rest of the permits are state permits or borough approvals. And what we've done is we've decided to undertake what we call the permitting preparedness review. And we've engaged a company called Stantec in Alaska. They're looking at the permitting documentation, and it's dotting the I's, crossing the T's, making sure that we haven't missed something. And the two key areas that I would say the focus of the permitting preparedness review will be on water management and tailings management. So that report should be completed towards the end of October. Once we review that information, we'll determine what the next steps are. If there's something else that needs to be done before we submit the permits, we'll do that. If not, then we'll submit the permits and start things going. And we see that permitting process taking roughly 24 to 30 months. As I said, there's one significant federal permit. We don't have any federal lands. I'm going to come back to why that's important in a second. And it puts us in a position to make an investment decision on the mine sometime around early 2024. So on the federal lands, Rick will be very well aware of this. One of the things that's come out in the U.S. recently has been the possibility of having additional royalties put in place at the federal level for companies that are mining existing mines on federal lands or developing new mines at federal lands, and the rates have been set or speculated to be between 4% and 8%. So in our case, because we have no federal lands, we would be not impacted by that at all because we're on the state lands or native lands as a result. So that's the next steps for us, is really about kickstarting the permitting process, completing this review, and then continuing to do the technical work necessary to advance the project.
Rick, you've been quite outspoken with us in the past about being no fan of government regulations in most cases. Can you weigh in on this timeline that Tony is suggesting, and let us know what your thoughts are on the permitting hurdles ahead and how suited or accomplished, I guess, Trilogy has proven at being at overcoming those as needed?
Well, I think one thing that really helps Trilogy is that they and predecessors have been involved with the local and state government for a very long time. They aren't a newcomer. They're known at both the state and local levels. I don't know about Alaska, but in the lower 48, when you're doing permitting like this, there are three government constituencies to deal with: federal, state, and local. And in the lower 48, at least in Wyoming, Texas, and Nevada, where I'm very familiar, any group within that can claim lead agency status, which is to say, if the local community has the capabilities, they can claim lead agency status, which means that they drive the permitting process. I always like to see that because I like to see local people who have local knowledge, who will be the chief beneficiaries and bear the chief costs, being primarily involved in the permitting process. In private investments myself in the state of Wyoming with indigenous bands, I have been in the lovely position of having my partners be the regulators. And that means that they impose restrictions and regulations on me that are locally significant, rather than imposing regulations on me in Wyoming around some project that worked in Florida, as an example. I'm subject to more relevant and more intelligent regulation. And my hope is that the same sort of circumstance will occur in Alaska. I don't know anything about the capabilities of the local indigenous communities in terms of managing a permitting process, but I can only hope that local concerns and considerations become paramount in the permitting process. I know that the state of Alaska is broadly pro-development, and the state of Alaska also has long experience in things like remote road construction, environmental management in Arctic and subarctic locales. And it makes absolute sense that from a regulatory perspective, the more local the regulators, the more specific the knowledge, the better. And I want to return briefly for your listeners' benefit to something that Tony said about the royalty. An 8% royalty is off the top. It isn't burdened by return of capital. It isn't burdened by cost of capital. And it isn't burdened by operating expense. The big thinkers in Washington would have you believe that 8% of the revenue is a fairly small slice, when often in the mining business, that's 80% of truly free cash, which is to say cash after the recovery of the investment, after the operating expense, and after the cost of capital. They want you to believe that it is 8 cents out of the dollar, which is ridiculous. What it is capturing an enormous part of the margin before the payback of capital employed. That's a very polite way of saying it's theft.
In that environment, there's got to be a lot of good that's going to come from having your ducks in a row. Tony, it sounds like you're getting some expert guidance with your permit preparation review, that sort of thing, to get ready to make sure there's no unnecessary delays in the process. You did mention before we got started that there'd be an opportunity to talk about some expected upcoming news. I know you can't pre-announce things before they're announced, but what kinds of things are you looking forward to and anticipating, with anticipation when you're going to be able to announce?
Sure. So we're working on two things right now. One is we're looking at opportunities outside of a district. So as you and our listeners would know, and Rick would know, that our primary focus is the Ambler Mining District, which is a joint venture with South 32. And we each own 50% of the JV, which includes the Arctic and bornite deposits and other targets within that exploration district. The JV has about, I would say, last time I looked, they had about $135 million in cash at the JV level. So we have a lot of money to fund the development activities of the JV, and that JV was formed in the beginning of 2020. So one of the things that South 32 did shortly after the JV was formed is they staked an area outside of the JV area called Roosevelt. And Roosevelt is a large area close to where the proposed Ambler Access Road is. So what we've done is we've looked at some adjacent areas in and around that area, and we should have some information in terms of what our plans are to look at possible exploration outside of the Ambler Mining District. And it would be, similar to what South 32 is thinking about doing, looking at it from a 100% perspective and giving ourselves some opportunities to think about other opportunities that a trilogy can focus on that are outside of the Ambler Mining District. So something on that front should be coming out shortly in terms of giving the market a sense of what we're looking at and why. And then the second thing that we've been working on is the second significant deposit in the district called bornite. And bornite is part of the JV, the Ambler JV. It's about 180 million tons of 1.6%. Copper, it's got two components, a 60 million ton, 3% underground deposit, and then 120 million tons at roughly 1% open pit. So we're going to be on a trilogy basis looking at releasing some information about that resource between the underground and the open pit, which will give the market a better sense of, what, based on the work that we've done, how we would see mining costs associated with that. We won't be giving out capital numbers, but we'll be giving some information that will certainly help a market appreciate the value of that deposit, which I would say right now, we're not, certainly within the current share price, there's not any value being attributed to that project at all. So it's important to give a bit of visibility with respect to that. And the idea is that once we release that information, we'll take the detailed work that we've done and we'll pass it on to Ambler Metals, the JV company. And the JV company will then be able to look at that information and determine what we do with it going forward. So those are the likely two releases that will be coming out. In addition to, we'll have news coming out on drill results. Rick made the comment about people and services. This gives you a sense of just what's happening in the industry. Typically, the drill core would be sent to a lab in Alaska or in British Columbia. where those services are. In some cases, our samples are actually being sent to Mexico because they don't have the capacity to deal with those in a timely basis in Alaska or in BC. So it just tells you, what we're facing as an industry in terms of timelines on getting services done that typically would have been turned around much more quickly.
Rick, I wanted to know if you could weigh in again about some of that idea of upcoming news. When you have a company like Trilogy, which has done exploration, is doing development, you're an analyst. You look with an eye for investment. You look for value where it may be latent and haven't been recognized by most. Do you have any reason for particular interest in the type of potential value that Trilogy may be able to announce in the future? Have you seen this? Have you seen this book played by them before? I mean, can you help us understand what you look for as a value analyst?
As a value analyst, before I looked on my upside, I looked at protecting myself from downside. And the market capitalization of Trilogy and the cash levels, which is to say the enterprise value, is attractive to me. I don't feel like I'm paying very much for what I get. And I don't have to worry in the first instance about Trilogy going out and raising some money to continue the beneficiating project because they already have it, which provides me some comfort. I also don't have to worry about a very small company, Trilogy, having to pay a whole bunch of employees to have all the skill sets required to build a mine because they have a partner called South 32 that already hires all those people. The reason, Donegan, that I have always liked the prospect generator business model is because you have a small exploration team that stakes a project and they farm it out to RTZ. They don't have to have all those people on staff to evaluate the project. RTZ has them. And with Trilogy, they don't have to have that whole depth of mine development and mine operation team because their funding partner does all that on their behalf, which I like. So what I like particularly about Trilogy is relative to other copper development stories, my downside is covered. I get to focus on my upside as opposed to be scared to death about my downside. The other thing I love is grade. The numbers that Tony was throwing around blithely, 4.5%, 3.1%, 1.5%. Keep in mind that the average mined grade for a copper mine worldwide is 0.5%. Arithmetically, 4.5% is better than 0.5%. Tony and I both grew up in first the BC and later the Chilean porphyry industry. We grew up around gigantic deposits. And what you learn when you come out of those environments is that tons, which is to say size, are a cost. And grade is how you get paid. So I'm not saying that there's anything wrong with economic, large-scale, low-grade, easy-to-mine, good metallurgical deposits. But when I hear about a 4.5% deposit in a 0.5% world, I get excited. Tony's former employer, Ivanhoe Mines, made just such a circumstance in Congo a fairly difficult place to work because they're talking about 6% grade, again, in a 0.5% world. I guess the third thing that appeals to me about Trilogy, let's get this out for the record. I'm a shareholder, so I'm talking my book. But every really good geologist who I know who has looked at this doesn't talk about Arctic and bornite. They talk about a camp. They talk about a district. They talk about the fact that copper mineralization that is this profound almost never occurs in isolation. So what I like is that a bunch of my downside is covered because of the size and tenor of the deposit, because of the cash already in place. It doesn't have to be raised. And because of the caliber of the human resources resident in the joint venture partner. So I get to focus on the upside. The upside is the road. The upside is the permitting process. And the upside is the fact that these deposits almost never occur in isolation. Now, these are personal criterion. And I would suggest that your listeners and readers develop their own criterion. But since you asked me the question, I answered it.
Yeah, no, we appreciate that. That's one of the things we especially benefit from when we do these panel interviews together with a guest is we get to hear your thought process and benefit from your experience. So thank you. Tony, could you tell us about where you see Trilogy Metals relative to the competition in the overall copper development pipeline? Again, within the context of what we've been told to expect is this imminent metal shortage, there's going to be a time when there's not enough. So those who are either closer to being able to produce or those who know how to get there faster than others or that sort of thing may have an advantage that's not obvious to all at a distance. So can you give us your own personal assessment, and then maybe Rick, if you could weigh in too on that same question, where you see the company relative to the competitors in the pipeline?
Sure, I'll give a bit of color, and I want to come back to one of the comments that Rick made as well, just about the porphyry side. So our timeline right now is we want to get the permitting process going so that we're in a position to make an investment decision in 2024. The road work is moving forward. There's a detailed engineering process that's ongoing with respect to the road. And the idea is that road construction on the proposed Ambler Road, which, by the way, is being built by ADA, the state of Alaska, effectively, and we would enter into a tolling agreement with them, would also commence once a permitting decision is made. So that would be at the beginning of 2024, with a view that we're targeting sort of 2028 to be in production, assuming everything goes according to plan. So that's what our timeline is as far as bringing this, the Arctic mine into production. It doesn't factor in how bornite would be developed. That would be separate, and we'd have to look at bornite separately. But I think it's important to highlight the value of bornite within the context of our portfolio. The interesting comment about grade, and Rick mentioned Ivanhoe, and I think a couple of things that I'll throw out with respect to Arctic. So our feasibility study at $3 copper, $1,300 gold is $1.1 billion NPV with a 27% IRR. If we look at it at spot prices, it's more like $2.3 billion NPV after tax at 8% with a 40+% IRR. So we did a little comparison of our project to another project in Alaska. I'm not going to say who it is, but your readers or the people that are watching this interview will figure it out. They released a PEA, and their capital number was roughly $6 billion, and they had a $2.3 billion NPV for a copper gold project. And so I asked our folks to run the numbers using the same copper price, which I believe was $3.50. And our NPV came out to roughly $1.7 billion for a proposed 12-year mine life. And as Rick knows, we're really focused on exploration in the district. So we're hoping to increase mine life significantly beyond that 12 years. And then what we looked at was what we call a profitability index. So in our case, when you look at initial capital plus sustaining capital, our profitability index was 1.7 times. And this particular project was 0.3 times. So essentially what you were getting is a scenario where someone is going to spend $6 billion of initial capital to get roughly $600 million more in return in terms of the NPV value. They're going to have a much longer mine life, but we expect to have that as well. And that was, the return for the difference between $1 billion of initial capital versus $5 billion or $6 billion of initial capital. So that's what people need to think about with respect to Arctic, and that's where grade factors in. So when you're at 4.3%, 4.2% copper equivalent grade with a mix of gold and silver and zinc and lead in there, which could change those percentages based on where those prices are, it puts you in a very strong position to be able to really have significant returns with respect to the deposit, particularly if we're successful in growing the inventory through the drill bit, which we expect to be able to do.
Rick, any thoughts to add to that based on the relative position of Trilogy versus others in the pipeline?
Well, I think the case is very clear. Profitability ultimately is what matters. I mean, narrative moves markets in the near term, but markets move on the long term according to arithmetic and probability. And this sort of profitability, the amount of money left over after the recoupment of capital costs, is what the whole game is about. Tony just said something else that's of interest to me. We've been doing a fairly deep dive into the royalty and streaming business lately, because the junior royalty companies, the junior streaming companies, have suffered the same precipitous price decline as the other ones are, and it's become more attractive to us. And one of the things that we have learned is the efficiency from a developer's point of view in streaming the copper and silver. Those cash flows in a royalty and streaming company, particularly in somebody big like Wheaton Precious or Franco-Nevada, can be as much as 20 times EBIT. Well, that same cash flow in a base metals company would be priced at 6 times EBIT. What that means is, as a financing mechanism, when you're looking at the whole $1 billion upfront capital cost, there may be a circumstance where a gold and silver deposit of this magnitude could be monetized via a stream. And the upfront payment, I'm not suggesting that Tony is going to do this, but the upfront payment for monetizing the gold and silver cash flow in a vehicle which enjoys a higher EBIT margin could pay for a substantial amount, perhaps all, as an example, of the equity required to develop this project. Wheaton Precious has made the case that very often the royalty and streaming component relative to the equity component means that of the equity that goes into a project, the royalty and streaming companies contribute well more than half to generate sort of 20 or 25% of the cash flow, which is valued higher by the market in a segregated gold and silver streaming opportunity. So whether or not Tony and his partners at South 32 avail themselves of the advantage which could be achieved by monetizing a precious metal stream, prospective investors and speculators need to take it into account in terms of assessing the cost of capital necessary to put this in production.
Just another example of how you're looking at this game from a much more sophisticated viewpoint, more layered than most, and really appreciate that insight as well. Tony, any final thoughts for our viewers on who would like to find out more about Trilogy Metals?
Well, first of all, we're listed on the Toronto and New York Stock Exchange under the ticker symbol TMQ. More information on the company is available on our website, trilogymetals.com. One last comment, just to sort of play off of what Rick was talking about. We've had the opportunity recently of attending 2 conferences in person. First time we've done that in the last 18 months. We're down at Beaver Creek, and we were down in Denver, and we had roughly 50 meetings, and we had certainly a significant number of meetings with corporates and streaming companies that are interested in looking at the streaming potential for a project like Arctic in particular. And the way our arrangements work with our partner South 32 is that each party is able to get their access to their pro rata share of the metal. So while we don't know if South 32 would be interested in looking at streaming on a 100% basis of a metal that's available in terms of gold and silver that would be produced, which would be about equivalent of 80,000 ounces a year, which is sizable. Trilogy would certainly be in a position to be able to look at streaming with respect to their share of the metal. And it's something that people are very aware of. And I think, as Rick pointed out, it gives us lots of flexibility to look at potential financing options. It's not necessarily saying that that's where we're going, but it is just about cost of capital and how you look at accessing capital within the market. So we feel we're in a good position. Have a look at the website, please. Presentations are on there, and we would be happy to talk to anybody that's interested in getting more information on Trilogy. And once again, thanks to both you and Rick for your time today.
And before I let you gentlemen off the hook entirely, Rick, I wanted you to just plant a seed, if you would, with our viewers, because the current investing environment, as you talked about in a recent seminar that you produced called Robinhood, Reddit, and the Rise of the Retail Investor, is a very momentum-driven. Sometimes there's a lot of people expecting to see a squeeze and have results within a few weeks or something like that. What we're talking about here is a timeline that has to develop. There's a organic time constant here that you can't just snap your fingers and get this done. Could you just give us a nugget of your personal philosophy of being that kind of an investor?
It isn't a personal philosophy. It's just paying attention to fact. For some reason, people believe that money can be made in positions where they don't have any commitment, where they have hesitancy holding stock over a long weekend. That's not the way progress is made. Money is made in investing by answering a series of unanswered questions, and that takes time. It's odd that at age 68, with less time on Earth, I've become more patient. It isn't because I've become older. It's just because I've recognized that money is made in 5-year or 6-year chunks. It's not made in 2 or 3 year chunks. People are odd, too, in that, as an example, if they believe the gold price is going up or they believe the copper price is going up and they want to be involved in the sector, when the equity prices fall, someone who professes an interest in being long in the sector seems to be depressed when the prices fall. That's like saying if you wanted to buy a winter coat, you are depressed because there's a plethora of sales. If you want to be in a sector and the equity prices in that sector are falling, it should make you happy as opposed to sad. So for me personally, when I look out 5 years and I see the inevitability, in my view, of shortages in the copper business, the fact that the copper equities aren't responding, I personally see as an unalloyed good. I also see the wind in the sails of precious metals, and the fact that we've had softer precious metals, and in particular softer precious metals equities prices for 12 to 15 months. It's odd that that causes distress for people who profess to be fond of the sector. For me personally, this is the best of all circumstances. These companies were able to raise money at large premiums a year and a half ago. I get companies that have done work and still have lots of cash left over, and I get them at a 50% discount to the money that to the price that the smart money paid a year and a half ago, and I'm supposed to be aggrieved. This to me is the best of all possible circumstances.
Appreciate that as well. And just Tony Giardini, President and CEO of Trilogy Metals, and Rick Rule, President and CEO of Rule Investment Media. Thank you both for joining us here on Liberty and Finance.
A pleasure, Dunnigan. Might I make my offer?
Oh, please.
For those listeners who have enjoyed my thoughts about this particular resource stock, if you'd like to hear me and hear my thoughts on your portfolio, the good, the bad, and the ugly, you can do that by accessing a website, ruleinvestmentmedia.com. Enter your natural resource stocks, hopefully including Trilogy. I'll rank them 1 to 10, 1 being best, 10 being worst, and I'll make individual comments where I think my comments might have value. In addition, I will include, if you mention the word charts in the question and comment section, the Barron's Gold Mining Index chart, which is the most all-encompassing gold mining index around, going back 60 years. Wonderful for envisioning the anatomy of a gold bull market or a gold bear market. And I will include also a 100-year commodity chart, which will talk about how cheap or expensive commodities are relative to other financial asset classes going back 100 years. One more time for this commercial, ruleinvestmentmedia.com.
Thank you, Rick, and thank you, Tony, for joining us.
Thanks. Thanks again.
Thanks all.